If you are turning 65 this year, or if you have parents hitting that milestone, you aren't just approaching retirement, you are walking straight into a financial minefield. You've been told your entire life that 65 is the finish line. You sign up for Medicare, you grab your Social Security check, and the government safety net just magically catches you while you ride off into the sunset. But let me be real with you. That is the greatest financial illusion ever sold to the American middle class. The truth is, the transition into retirement has been heavily weaponized with bureaucratic tripwires designed to siphon your savings back into the treasury. Today, we are doing a masterclass deep dive into a trap that I see wipe out six-figure retirement accounts all the time. It starts with one tiny, innocent misunderstanding. But because the Social Security Administration and the IRS now talk to each other in real time, it triggers a vicious chain reaction. We're talking about permanent lifetime penalties, inflated tax brackets, and a brutal 25% IRS excise tax on your hard-earned money. By the end of this video, you will know exactly how the system traps you, the specific legal forms you need to defend yourself, and the precise sequence to follow to get out. Turn off your notifications, grab a pen, let's get to work. To understand how this trap snaps shut, let me introduce you to Robert. Now, Robert is exactly like you or someone you know, a smart, hardworking guy. He's 65, a career engineer, and he finally decided it was time to hang it up and enjoy his early retirement. His company absolutely loves him. As a parting gift, they offer to heavily subsidize his COBRA health insurance for the next 18 months. Robert thinks, fantastic. I've got premium health coverage. I don't need to wrestle with the government and enroll in Medicare Part B right now. I'll just wait until my COBRA runs out. It sounds incredibly logical, right? It sounds like the smart move. But here's the crazy part. Robert just made the one mistake that will cost him a quarter of his net worth. Fast forward 3 years. Robert is now 68. His COBRA ended. He bought a cheap private plan to bridge the gap, and then life happens. He suffers a minor heart attack. He survives, thank God, but he's facing a $40,000 medical bill. He calls Medicare, assuming he can just sign up for Part B and have the surgery covered like everyone else. But the agent on the phone sounds ice cold. She tells him, "Sir, you aren't enrolled in Part B, and because you missed your window 3 years ago, you're stuck." Robert tries to argue. He says, "But I had COBRA. I had health insurance the whole time." The agent's response is the first domino in a chain reaction that is about to ruin Robert's decade. And this brings us to the first legal trap. Section 1839B of the Social Security Act. This is the law that dictates Medicare Part B penalties, and trust me, it has a zero-tolerance policy for innocent mistakes. Here is the brutal truth that your HR department or your insurance agent probably never told you. Medicare does not care if you had COBRA. Medicare does not care if you had a fancy retiree health plan from your old job. To the federal government, the only thing that exempts you from the Part B penalty at age 65 is having what they call creditable coverage based on current active employment. Because Robert was retired, his COBRA was technically based on past employment. In the eyes of the law, Robert was essentially uninsured for 3 full years. Make sense? It's a total technicality, but it's a $40,000 technicality. Let's do the math, because the math is honestly terrifying. The Part B penalty is 10% of the standard premium for every full 12-month period you could have had Part B but didn't. Robert missed 3 years. That is a 30% penalty added to his Medicare premiums. And here's the kicker. That penalty isn't for a year. It's not for a decade. It is for the rest of his natural life. But look, a higher monthly premium is just a paper cut compared to the real disaster that's about to hit Robert's bank account. Since his coverage didn't kick in immediately, he had to pay that $40,000 hospital bill entirely out of pocket. To get that cash, He panicked. He went into his traditional 401k and liquidated $40,000. He thought he was just putting out a fire. In reality, he just poured high-octane gasoline on his tax return and alerted the IRS. Welcome to the chain reaction. You won't believe what happens when the IRS tells Social Security about that one-time withdrawal. When Robert pulled that 40 grand out of his traditional 401k to pay the hospital, he thought he was making a clean getaway. He paid the income tax and figured the nightmare was over. But here is the thing about the federal government. They have a very, very long memory. In fact, they have exactly a 2-year memory. You see, every penny Robert took out of that 401k was treated as ordinary income. It spiked his modified adjusted gross income, what the pros call MAGI, to a level he hadn't seen since he was working full-time. Fast forward 2 years. Robert is finally getting his life back on track. He's sitting at his kitchen table, sipping coffee, and he opens a letter from the Social Security Administration. It's an IRMAA notice. Now, IRMAA sounds like the name of a sweet old lady who bakes cookies for the neighborhood, right? Wrong. IRMAA stands for Income-Related Monthly Adjustment Amount. It is a stealth tax disguised as a surcharge, and it is absolutely brutal if you don't see it coming. Because the IRS and Social Security are now best friends, the IRS told Social Security about Robert's massive income spike from 2 years ago. Social Security looks at that number and says, oh, look at Robert. He's a high-income earner. He clearly doesn't need the standard Medicare rate. The result, Robert's Medicare Part B and Part D premiums don't just have that 30% lifetime penalty we talked about. No, it gets worse. The base premium itself triples because he's been bumped into a higher IRMAA bracket. We are talking hundreds of extra dollars every single month. And here's the cold, hard reality of how they collect that money. They don't send you a polite invoice. They don't ask for your permission. They deduct it directly from your Social Security check before the money even hits your bank account. It's like a legal mugging happening in the background of your retirement. Robert checks his bank balance the next month and his jaw drops. His Social Security deposit has been decimated. It's a fraction of what he was expecting. He's now in a full-blown cash flow crisis. He's trying to figure out how to pay his property taxes and keep the lights on while spending 8 hours a day on hold with government agencies. He is stressed. He is exhausted. And because he is so focused on fighting this IRMAA fire, he takes his eye off the ball on the biggest rule of all. Robert turns 73. And in the middle of all this bureaucratic chaos, he completely forgets to take his required minimum distribution, his RMD, from his IRA. Now, if you think the Medicare penalties were bad, you haven't seen anything yet. This is where we meet the final boss of the American tax code. Under the Secure 2.0 Act, if you fail to take that RMD on time, the IRS imposes a devastating excise tax. It used to be 50%, which was basically a death sentence for your account. The new law generously lowered it to 25%. And I say generously with a massive amount of sarcasm. Think about that for a second. A 25% penalty on money Robert never even touched. It's just sitting there, and the government takes a quarter of it because he missed a deadline while fighting their other mistakes. Look at the wreckage of Robert's retirement. It all started with one innocent choice about COBRA at age 65. That triggered the out-of-pocket bills. The bills triggered the 401k withdrawal. The withdrawal spiked his MAGI. The MAGI triggered IRMAA. IRMAA shrank his Social Security check. The stress caused the missed RMD, and the missed RMD triggered that final 25% IRS penalty. It is a perfect self-sustaining destruction of wealth. The government didn't have to break any laws to do this. They just waited for Robert to trip over the rules they wrote. But here is the good news. You are not Robert. You are watching this video. And right now, we are going to go on the offensive. I am going to give you the exact cheat codes to nuke these penalties and tell the IRS and Social Security to back off. Ready? Let's get into the tactical defense. Look, I didn't lay out that horror story just to scare you. I'm not going to leave you bleeding out in the gears of the bureaucratic machine. We are going to fix this right here, right now. But you need to listen to me very carefully. The sequence of how you execute these steps is a matter of life and death for your portfolio. If you do these out of order, the government will categorically deny your claims. You have to be precise. You have to be surgical. Step 1 is what I call the preventative strike. This is for those of you who are over 65 but still working or just about to retire. If you are covered by an employer plan with more than 20 employees, you actually don't need Part B yet. You're safe for now, but the moment you decide to walk away from that job, you must demand that your HR department fills out Form CMS-L564. Write that down, CMS-L564. This is the request for employment information form, and it is your absolute shield against lifetime penalties. This single piece of paper proves to Medicare that you had active, creditable coverage based on current work. It tells the government, hey, I wasn't slacking off, I was insured. You submit this alongside your Medicare application, and you completely bypass the lifetime penalties. But remember, and I cannot stress this enough, COBRA does not count. If you try to use COBRA as an excuse, they will laugh you out of the office. Get the form from your HR while you're still on the payroll. Now, step 2, the IRMAA reversal. Let's say you've already been hit. You got that terrifying letter saying your premiums are tripling because of a one-time income spike. Maybe you sold a house, or like Robert, you had to pull money from your 401k to cover an emergency. You do not have to just sit there and take it. The law allows you to appeal if you've experienced what they call a life-changing event. And guess what? Retiring or even just reducing your hours counts as a life-changing event. You have a 60-day window from the moment you get that notice. You need to go online and print out Form SSA 44. On this form, you're going to find the life-changing event section and check the box that says work stoppage or work reduction. By filing this, you are legally demanding that the Social Security Administration ignore your tax return from 2 years ago. You're telling them, use my estimated income for this year because I'm retired now and I'm not making that big money anymore. If you execute this correctly, it instantly kills the IRMAA surcharge and restores your Social Security check to its full amount. It's like hitting a reset button on your cash flow. But what if you're already in the deep end? What if you missed your RMD and you're staring at that 25% IRS penalty? That brings us to step 3, nuking the RMD penalty. Most people just pay the fine and cry about it. But the IRS has a hidden back door that almost nobody uses. First, you have to fix the mistake immediately. Take the money out of the account that you were supposed to take out in the first place. Then you're going to file IRS Form 5329. This is the additional taxes on qualified plans form. But here is the secret sauce. In the specific section for excess accumulation, you are going to write the letters RC in the margin. Those letters stand for reasonable cause. You're going to attach a typed, highly factual letter explaining the emergency. If you had a medical crisis or a major family disruption, tell them. In 9 out of 10 cases, if you correct the mistake before the IRS catches you and your letter sounds professional, they will waive the penalty entirely. But here is the catch. You must fix the IRS issue before you tackle the Social Security appeals. You want your tax record to be clean before you start arguing with other agencies. Sequence is everything. If you walk into a fight with the government with messy paperwork, you've already lost. Make sense? Look at the matrix we just decoded. You have Medicare, Social Security, and the IRS. Three massive federal behemoths that usually don't talk to each other. They don't give you a unified instruction manual, but they are perfectly synchronized when it comes to taking your money. People always tell me the system is broken. But after seeing how these penalties stack up, I have to disagree. The system isn't broken at all. It is working exactly as it was engineered to work. It relies on the complexity of the tax code and your lack of legal knowledge to quietly siphon wealth back to the Treasury. They are betting on the fact that you won't know the difference between COBRA and active coverage. They are betting on you missing that 60-day appeal window. They are betting on your silence. But today, you broke the algorithm. You have the forms. You have the laws. You have the sequence. You probably have a friend, a coworker, or a parent who is about to turn 65 and is walking right into this trap. Do not let them get slaughtered. Send them this video right now. It isn't just a video. It's a tool for financial self-defense. And honestly, it's a moral obligation to help them keep what they earned. If you want to stay 3 steps ahead of the system and protect your retirement from these bureaucratic landmines, you know what to do. Hit the subscribe button, turn on that notification bell, and leave a comment below if you've ever had to fight IRMAA or Medicare. I read every single one of them. Stay sharp, stay vigilant. I'll see you in the next masterclass.